Well, welcome to. I think this is our third, maybe fourth. I think it's our third lunch and learn. And so, for those of you who don't know me, I'm Brian Gilpin. I'm the president of Wider Path and also the head of capital markets at Embrace Home Loans. We know we have some special guests, realtor partners. We have some folks from community development corporations, as well as the Embrace family is on today. And we're just excited to have you. We're excited for our guests, James and Jennifer from Freddie Mac. But before we move over to Sarah, along with James and Jennifer, I just want to give you all an update. We're hopefully in the final steps of getting our 501c3 with the federal government. We have responded to some questions that they had for us, and hopefully things within the next, we're hoping within the next month here in March, that will come through. And with that, we will have some grant money to be able to give out as part of Wider Path to be able to help with down payment assistance. So obviously we know how important that is, and we look forward to being able to give that blessing out to folks. So with that, I'm going to hand over to Sarah and let her formally introduce our guest, and look forward to hearing today's talk.
Hi, everybody, and welcome. Thank you so much for being here. Just want to do a little bit of an introduction to the work that Jen and Jim have joined, and to just thank them for being a part of our team today and for partnering with Embrace and this initiative to really advance first-time home buyers and to make sure we really serve our communities super well. And I just want to say a huge thank you to Embrace. It's just been such an incredible privilege to work with every single person that I've had the opportunity to work with, and to experience your hearts and your drive and your passion for communities, and to know that, as I'm an educator, I come to this work by virtue of being an educator and a community developer. And I am learning so much about the mortgage industry and about lenders and about realtors and about how you all are on the front lines of educating communities and families and how to not just get into homes, but stay in homes. And I just want to say thank you to the many people who have joined the community of practice, the Honoring Stories community of practice, and for all the ways that you are teaching me and helping me understand the mortgage industry and the challenges where we've just really been in there problem solving and grappling with how do we do this? How do we work in these times in the markets that we're experiencing to really be builders of communities and builders of people, and to walk in step with homeowners and to have hope and to bring hope when so many people are experiencing so many challenges. And just want to put a plug out that we are inviting you to join our fourth community of practice, which will start on March 17th. It will run through May 5th. And each one of the cohorts is learning how to really work well with first-time homebuyers and how to work well with community development corporations that we're starting to partner with. And we're collectively developing regional lists of nonprofits and lists of places of worship and anybody who's involved in homebuyer education, so that every loan officer, every realtor can have a community list that they can plug people into, no matter where they are on the spectrum of homeownership, that there are resources available to them. And so we're building those out with our communities of practice, and going into new areas as people come into the communities of practice, so that we can really position you to be a community resource to anybody who calls you, and to really become a trusted advisor in deeper and deeper levels of the community, knowing that you've got the first-time home buyer products, that you've got grant money, that you've got everything that you need to be able to help them keep moving forward on their journey towards homeownership. So we invite you to come and be involved with that. And without further ado, Jen and Jim have spent a lot of time preparing this presentation for us. They are with Freddie Mac. I will let them introduce exactly what they do at Freddie Mac, but they have just been so passionately involved in the work of Embrace and the work that we're doing to really build partnerships with community development corporations and to really walk well with first-time home buyers. And they're going to help us set our vision. They're going to help us understand the market. They are going to help us understand what the world is like for first-time home buyers and what kinds of products they have available. And they're also just going to help us understand how the housing ecosystem works and how we can plug ourselves right into the center of that ecosystem in a way that we can be at the heart of communities and really work well with our community partners and with the other advocates who are out there actually advancing affordable housing. We know that's a huge issue. And so we want to be able to plug right into those who are doing the work of making sure there is affordable housing for communities. So Jen, do you want to introduce yourself?
Please, thank you. Good afternoon, everybody. Thank you so much for having us. As Brian and Sarah said, I am Jen Roach. I am so happy to be here with all of you today. As you know, at Freddie Mac, we always strive to make home possible, but as we head into 2022, we are increasing our goals, and we have affordability, sustainability, and equity at the center of it. I am the Northeast rep for Freddie Mac, so this is, I live and breathe this every day, as does Jim Hall. He's our affordable lending manager. But our real mission and purpose for being here today is that we can't achieve these goals without partners like you. We rely on our partners to hit our goals. We need Embrace to be that partner that contributes to the creation of sustainable communities. We are not originators, and we can't hit these goals without you. So as loan officers, we know that you are on the front lines to homebuyer education. As loan officers, you are the master educators on home lending options, and you are the advocate for home buyers. We are here today to help arm you with product knowledge and resources that will assist you serving your communities. Today, we'll discuss the current state of housing, what options we have available to you for affordable products, and what the future home will look like, or what we think the future home will look like. In the spirit of partnership, I am also here today to learn from myself what challenges you are faced with on a day-to-day basis within your markets. What obstacles and trends are you being tasked to overcome to make home possible? We've created an affordable lending scorecard for all of our partners so that we can measure certain buckets of affordability. You may not be aware, but we do track and measure all deliveries that come into Freddie Mac, and we've recently revamped our affordable scorecard. So now it has always included, but it will include low income, very low income refi, home possible, and many other categories. And our hope is that we use this scorecard month over month so that we can see what strides we're making within affordable lending space, and also see what markets need further improvements and attention. So even though we are here presenting, I encourage everyone to participate today. I know we'll have time at the end for questions and discussions, but I would love to hear from all of you so that I can be your advocate here at Freddie Mac. With your feedback, I can look to improve on what needs to be done better to serve your markets and help to contribute to the creation of sustainable communities as well. We already heard from Sarah about HFA issues and home loan concerns, so we will focus on those today, as well as the home possible products. So with that said, I would like to turn to Jim Hall, our affordable lending manager, so that he may begin the presentation and we can start on this journey together. So Jim, I'll turn it over to you to drive.
All right, thank you, Jen. First off, a big thank you to Brian and Sarah for this invitation to share some time with the Embrace Home Loans family and your business partners. Really appreciate it. So you're a great lender, and Freddie Mac is proud of the partnership and relationship that we have with your organization. And as Jen and Sarah said, my name is Jim Hall. I also go by James. My 82-year-old mother calls me Jimmy, so I'll answer to that also. You'll be getting a copy of the slides that I'm going to present to you today, so you don't have to jot all this information down. On the introduction slide here, you see my email address, so feel free at any time to email me with any questions or concerns, and I promise that I will get back to you. If I can't answer your question, I will research it with a subject matter expert here at Freddie Mac to make sure that I do get you the answer. So my role as affordable lending manager is pretty varied. Internally, I partner with account executives like Jen in promoting our affordable lending programs. I also partner with lenders, realtors, housing finance agencies, housing counselors, throughout the country. My region is the eastern region, so it's Maine down to Florida. So it's pretty extensive. So I get to see a lot of different, areas and see what they're up against throughout the country. And it's tough right now. It's a battle. So we're all in this together, and hopefully you'll see that theme throughout the presentation. So we all know right now that there's a severe housing shortage, especially in the affordable arena. The laws of supply and demand are really dictating what's going on, and it's a challenge to the home buyers out there, especially the first-time home buyers, because of the shortage. Not only with existing properties, but with new construction. new construction is really is pricing itself out of the affordable world because the price of lumber is through the roof. And one of my business partners of Virginia Housing was showing me that they're being very innovative down there. They're looking at container type homes. They're looking at 3D homes, which are basically, computer generated and then built out of cement, which is, very, very interesting how they pour the cement and they're not using lumber, which also takes us back because if you recall your history books, Thomas Edison, who's most famous for, the light bulbs, he was making cement homes in the early 1900s. He saw that as an alternative, but the inverse happened to Edison, and it flopped on him. It was one of his inventions that actually flopped because at that time in the early 1900s, lumber was much cheaper than cement. But there are some of these cement homes that Edison built here in New Jersey, where I live, and also he ventured out to Gary, Indiana, and made some. So again, we're challenging our business partners because not one company or one segment of our industry can solve this housing shortage. We're all in it together, and we have to help these home buyers, especially first-time home buyers, achieve that American dream and get out of the renter ranks or get out of mom and dad's homes. So I was looking at this slide, which with the war over in Ukraine right now, could change dramatically. So I have to, give you an asterisk here. This is a pre-European war slide, talking about the economy, because we do not know really how, the markets are going to, play, after this, this issue over overseas. But we were looking at, an economy that was growing. People were going back to work after the pandemic, which was a very, very positive sign. There's a lot of job openings throughout, especially in the service areas. And, we're encouraging people to, get back to work, get back into society, make the money and become eventually homeowners, buy homes. And, one issue we have to look at is inflation. How's that going to play into this? And, we see the effects, in the short term right now. Prices of goods are going up. Also, prices of homes are going up. And, in a few more slides, I'll go over, where the price points are and how that's affecting the economy. And also, interest rates are starting to go up. So the Federal Reserve has a plan to combat inflation by raising the interest rates. Okay. But again, like I said, the caveat here is we don't know what's going to happen, with the war in Ukraine. And so we just have to keep an eye on that. So as I had mentioned, home prices have gone up, which a person like me, I've owned a home for 29 years. That's great. My equity is going up. I'm happy with that. But it's a challenge for the first-time home buyer. And this screen here, shows you home equity versus single-family mortgage debt and how it's risen since 1990. And you can see, since really 2012, there's been a tremendous spike in home equity, which helped lenders, with the low interest rates of the past 2 years, help a lot of people with refinances and really saved a lot of people a lot of money with their principal and interest payments. So the rising home prices, helped existing homeowners, but again, it made it much more challenging to the home buyers, especially first-time home buyers. And Freddie Mac does a lot of surveys, and we're surveying rates all the time out there in the marketplace. And the first block here is the 30-year interest rate based on our mortgage surveys. And we did a 3-year snapshot here of what the rates are in 2021. We were forecasting 2022, and even further down 2023. And 3 to 3.6 to 3.9. Again, it's nothing to be alarmed about. rates in the high threes and low to mid fours is still a great interest rate. I entered this business in 1986. I worked for a company, this was pre-FICO scores. We used to grade mortgages based on A, B, and C credit. And we had a matrix that we had to follow. And the A borrowers got a 12% rate, the B borrowers got a 13% rate, and C borrowers got a 14% rate. So anytime I hear anybody say, oh, rates are going up, it's really a catastrophe. I said, well, if you can get a rate in the fours, you're still doing pretty good. So, don't let this affect your company's mentality, because look at it as glass half full. 4% rates are still good, especially on purchase money loans. It may shrink the the refinance opportunities, because a lot of people flooded into the refinance pool when the rates were in the twos and the low threes. And if you go down to the third row there, home price growth, we're looking at 2021 at almost 16%. Certain areas in the country are even higher than that. We've seen it to 20 up to 25%. In 2022, our economists are forecasting a 6.2% raise, and even lower in 2023. So the playing field, will reduce there and help with affordability. And this is just a snapshot of home ownership rates dating back to 1998, and it's pretty interesting to see how it really trended down for many years. With the opportunity pre-pandemic, spiked back up in 2018, and then took a drastic drop when the pandemic hit, as you can see there, 2019 going into 2020. So hopefully, with like I said, the economy rebounding and people getting back to work and getting more motivated out there to buy homes, we'll see this trend to go back up. And this is a look at the U.S. housing price index, and as you can see, the chart is going up, and so the values of homes are going up. And the bottom line there is the percentage and the change. You can see in 2020 how that's going up also. And again, that plays well into a refinance market that makes things more challenging in a purchase money market. And here's a neat look at percentages in the country. So Embrace knows what states you lend in. You can see the correlation with the appreciation by state with this chart here. And this is through April 2021. Our analysts are updating with newer data, and I'll be able to get new slides out to you once I do receive that data. So again, interesting information for you to digest and share with your colleagues. And like I said earlier, you'll be getting a copy of this information. And again, as I mentioned, Freddie Mac does a lot of surveys, our primary mortgage market survey, and we are really on top of interest rates. And as I mentioned, you can see that rates are starting to, creep up a little bit, nothing too drastic. Our last survey, we were looking at, mid-January at 3.6 range. I know, in speaking to lenders and the housing finance agencies, some have gone a little bit higher than that. But again, a rate in the fours to me is still, a competitive rate, and it shouldn't hurt the purchase money market. Could cool off the refinance market a little bit. And in this one here, this is the really this illustrates affordability. Okay, because when you have rising prices and rising rates, who's it going to hurt? It's going to hurt the first-time home buyer. It makes it less affordable for them, because with rising rates, that first-time home buyer is going to pay a little bit more in principal and interest. With the rising home prices, again, it's much more challenging with them for many factors. First of all, their mortgage is going to be higher because if they're going in with like 3% down, that's going to be more challenging. And also because of the lower supply, people with cash are going to win out in a bidding type situation versus a first-time home buyer who doesn't have a lot of assets. So again, affordability is, really, really at the forefront right now. Freddie Mac is, setting very, very serious and aggressive goals in the very low income and the low income markets. And, with a, lack of supply and, with higher, price points, each deal is precious. And that's why, Freddie Mac looks to really, really partner with lenders like Embrace, who have, a great vision to help people that need affordable lending. And, through their Wider Path Home Foundation, it just makes sense to, really, really, really partner with a company like Embrace, because it will help us all with our goals, our missions, to really, really also bridge the wealth gap in between, white home ownership and African American and Hispanic home ownership. So we're really, really, focusing on that world also. So let's talk about millennials. Okay, really, they are the market right now. I have two millennials. I have a 29-year-old son and a 26-year-old daughter. So I really, really, at times understand the millennial world, and at times I don't understand the millennial. But, we really, really have to help them because, of all the points that I'm making as far as the difficulties that, for them to attain home ownership, it's, people like us, lenders, realtors, housing counselors, everybody in this industry that have to band together to help these young folks really, really attain home ownership. Now, my son and his fiance went through the home buying process last year, and I thought it would be an advantage for him to have a father who's been a mortgage professional for 36 years to help him out. But all he really wanted to do was get his information via the cell phone. And, that was the way it was. And, that's what they're used to, and which is great. I was really happy for him that he was digging in and looking for information. But, I told him, I said, you can't disregard the human element here. You're going to have to get a realtor who you trust. You're going to have to get a loan originator who you trust. And he's like, well, why, Dad? I said, because they're going to be looking out for your best interests. I said, we are fiduciaries, being a fiduciary for you, it's about trust. It's about, the realtor is going to, look out for you as far as getting the most affordable home that you and your fiance can afford. Sales are wants and needs, but when you're a first-time home buyer, you may have all these wants, but you may not need it. And a really good realtor is going to point that out and say, hey, you're in this price range. You may want that, but that can be on your second or third house. This is what you need right now. Okay. And also, a loan originator is going to get you the most affordable loan program that you have, that they have on their menu, I should say. So they're going to be looking out for you to make sure that you're paying the proper costs on the mortgage, and that you're getting the best mortgage product from a principal and interest standpoint and a mortgage insurance standpoint. So all of us as professionals have to, if you're a millennial, you're there. But if you're not, if you're in my age range, or if you're in your 50s, it's important to be able to learn the language of millennials. And I say that to, everybody that I deal with, that you really, really have to learn and understand, what is going on there. And but don't ignore Gen Xers, and then we have Gen Z coming behind the millennials. We have to provide services to them also. But again, as you can see, the millennial households we're projecting are going to be close to 50 million by 2035, and it's they are carrying the market right now. And again, this slide tells the increase of 2020 up to almost half is the home ownership trend. So this just solidifies and confirms what I've been talking about. So again, it's great information, and if you're into statistics, these are trends that you should be following. And again, these are the purchase market is becoming more saturated with millennials, as I said. So again, the upward trend, and it's going to continue to go higher. So these are recent purchase mortgages issued to millennial buyers that are acquired by Freddie Mac. So this is not including what was purchased by Fannie Mae and government insured through FHA. But again, their numbers are quite similar. And this is a neat chart here that shows you that millennials getting into the purchase money market a little bit later isn't really affecting us that much, okay, because they are getting into the market. So just took them a little bit longer, but they are out there, and the opportunities to sell them a home and make them a mortgage will arise. So again, some interesting numbers here for you to take a look at as far as composition of households versus married couples, single females, single males, and unmarried couples. And education is really, really important. And going back to my son, I encouraged him to go through the Freddie Mac Credit Smart program. We're really, really proud of Credit Smart. We've had this tool for over 20 years now, and it can be done online. It's multiple modules. It's self-paced, and it really can teach your potential home buyer and potential borrower really how to budget and really get a grasp on what it's like to be a home buyer. So I highly encourage you to take a look at this. The web address is down there on this slide, which we'll provide to you, and it's free, and which is perfect. And there's no harm in learning what a debit and credit is, how to balance your bank accounts. A lot of these millennials don't realize what they're up against. They're going to have an electric bill, they're going to have a water bill, and so forth. And this really prepares them, to take that step from being a renter or, living with mom and dad to really, becoming a homeowner and really being able to handle, their monthly budget and get off on the right foot. So also, as far as, real estate professionals and loan originators, you can become a Credit Smart coach through this program. So if you want to be a community leader and really facilitate Credit Smart classes, we give you that opportunity. And if you go on this website, you can see, quarterly we have cohorts where you can go through the training to become a trainer. And really it will, put you out in the forefront of, in your community, because really this type of program is not taught in high school anymore. And college kids are really not, getting this opportunity either. So, you can do it in your office, you can do it in church groups, fire halls, community centers. We've had a lot of, real estate professionals and loan originators take advantage of this, and they've always said it's been worth their while, and it's it has sprung referral business for them. So it's a great opportunity. Now, part of Credit Smart, we have Credit Smart Homebuyer U, whereas Credit Smart is all encompassing as far as being a financial tool. Homebuyer U just focuses strictly on the elements of becoming a home buyer. It's 6 modules. Again, it's self-paced. It doesn't cost the potential home buyer anything. They can go through this. They can, get a certificate, which, for, Freddie Mac loan, we accept that as going through the home buyer education, obviously. So again, another great tool to use. Highly encourage it, and please take a look at that after this presentation and see if it will meet your client's needs. So I want to talk about housing finance agencies. Prior to myself coming on board here at Freddie Mac, I worked for 12 years at a housing finance agency, and I quite didn't really know what a housing finance agency was before I went to New Jersey Housing. And they are like a hidden jewel throughout the country, and they're here to really serve the affordable lending program. So if you're not doing business with housing finance agencies, please explore that opportunity. Now, they're not all the same. Each state has a different approach, and some are government entities, some are quasi-government entities. But they all have missions, they have charters, and they're here to help lower to moderate income folks. They provide down payment assistance programs, which are key and critical to helping first-time home buyers, because most of first-time home buyers don't have a lot of assets. They've been around for over 50 years. They came out of the vision that in the 1960s, Lyndon Johnson was president. And his vision for America was the Great Society. And, he's most famous for, the civil rights legislation and the Voting Rights Acts that he signed in 64 and 65. But in 1968, he signed the Fair Housing Act. And with that, the Fair Housing Act was there to, take a look at and provide, affordable lending and affordable housing to lower to moderate income folks. But Johnson's administration knew they couldn't do it all on a federal level. They took it to the states, and that's why housing finance agencies started to be formed. So a little history on that. And as far as the type of consumer that they are really helping out, this is a great indication here of the very low to low income borrower that housing finance agencies are helping. And median income through 2019 was almost 51,000 compared to 93,000 on all other mortgages. So again, makes for a perfect partner for Freddie Mac. Again, it helps us, help that segment of society is very low income and low income, and and it just would make sense, with Embrace's vision for the wider path home. That a lot of people that Embrace is looking to help would fall into this income category here. And also, as I mentioned earlier, Freddie Mac is making a aggressive effort to bridge the wealth gap between African American households and Hispanic households with white households. And housing finance agencies have been at the forefront of this for decades. And this this chart here shows you, as far as the red line is the percentage of loans they made to people of color versus the blue line, which is the market. So you can see throughout the years, housing finance agencies have been either above or at the market. And again, it just makes, again, perfect sense for Freddie Mac to partner with housing finance agencies, to help us meet our goals. And then again, this would really correlate to Embrace's Wider Path Home Foundation with their goals in partnering with housing finance agencies. So Freddie Mac launched the HFA Advantage program, and that program is specific for lenders to use through housing finance agencies. So, and what does that mean? Lenders cannot deliver HFA Advantage directly to Freddie Mac, okay? So the loan has to be done through the housing finance agency, and it's a 3% down program. So it's more affordable than the government's FHA program, which requires 3.5% down. We allow for 105% total loan to value, the LTV. It's for 1 unit properties. There are income limits. This program is for 80% AMI and below, okay? And that's important to know. And again, that is the focus of this program to help, again, very low income and low income folks. Home buyer education requirements are determined by the Housing Finance Agency. We obviously encourage them to use Credit Smart because we think that's the best program because it's ours. And but you know, if the Housing Finance Agency has other requirements, then the lender has to follow them. And we also have charter level mortgage insurance, which I'll illustrate for you in a couple more slides, which you know, saves the consumer a lot more money. So again, it's a great alternative to FHA. And, you know, I'm not here to bash FHA because, you know, a conventional loan is much, much different than an FHA loan. You know, our credit risk standards are higher, whereas, you know, FHA will go down to much, much lower credit scores. But again, it gives an opportunity for lenders like Embrace and housing finance agencies to offer a conventional product out there along with their down payment assistance programs. So some of the highlights again on the HFA Advantage program, it's 1 unit. It can be used for purchase or no cash out refinancing, 3% down, 105% PLTV, 97% LTV. All the loans have to be underwritten through our automated underwriting system, Loan Product Advisor, LPA. There's no reserves required, but I always encourage if the consumer does have assets to put it in there because it is a risk factor that is being analyzed by Loan Product Advisor. So it doesn't hurt to put it on the application. So again, a great alternative to FHA if the borrower qualifies for the program. This chart here illustrates the charter level mortgage insurance that I have mentioned. If you look in the bottom right-hand corner on a 3% down, 97% LTV standard conventional loan, the consumer has to get 35% MI coverage. On an HFA Advantage program, 3% down, 97% LTV, it's 18% coverage. So we've almost cut the coverage in half. So again, it's a substantial savings, you know, for the borrower versus our standard, you know, conventional loan. And again, stacking up against an FHA loan, mortgage insurance on the HFA Advantage can sunset. It will go away when the loan you know, amount is below 80% LTV, whereas on an FHA loan, it's perpetual and stays on for the life of the loan and can be quite costly in that regard. Also, on our conventional loans, there's no upfront premium, whereas on an FHA loan, you know, they have to pay that costly upfront premium, which can be, you know, thousands of dollars. So again, if they qualify for the HFA Advantage, it's a great savings for them. I won't dive into this slide because there's a lot of numbers, but again, you'll have a copy of it, and this just illustrates, you know, the dollar amount in savings that that the consumer can procure over a five-year period. So it's depending upon the scenario, it's between $6,000 and $7,000 we illustrate here. But again, it just puts the numbers together for you, and it's a nice tool for you to have. And as far as housing finance agencies, you know, we've you know, put everything together on our website, you know, at this website address here. It's everything you need to know about housing finance agencies. So again, take a look at this after our webinar and bookmark this page if you feel that you know, it will help you out in the future. Our marquee affordable program is Home Possible. Now this is the program where Embrace can deliver directly to Freddie Mac. This isn't through the Housing Finance Agency. Again, there are some differences between this and HFA Advantage. You can go up to, you know, 4 units on this, whereas on the HFA Advantage is a 1 unit. This is a 3% down. It's for, again, 80% area median income and below. And again, it's a very popular program, you know, throughout the country. Many lenders use it. It does have reduced mortgage insurance, but not as low as HFA Advantage, where on the 3% down, that was 18% coverage. On Home Possible, it's 25% coverage. But again, a great program. We do hundreds of thousands of these loans, and lenders do really find that this is a really a value add for their product menu. Then we have Home One, which really isn't one. We don't consider this one of our affordable programs, but it works hand in hand. If you have a borrower where they go over 80% AMI, this program allows for that. It really doesn't have an income limit, but it allows for 3% down, and there's no geographic or limitations either. So it does come into play. It's a nice product to have in your pocket just in case you have that borrower where you're doing the income calculations. You thought you had the affordable loan, but then all of a sudden something changed, and your area median income's now 95%. So you don't want to lose the customer. You could still help them out with the 3% down payment option, but you would just have to run it through Loan Product Advisor under this product code here. And again, over 80% AMI doesn't have the charter level mortgage insurance, so this would have the standard mortgage insurance coverage. Okay, but it does give you a solution, and in case you do need it. And what I did, I included this slide. Gives you a little bit of a side-by-side comparison. It doesn't have all the guidelines, but it's a quick reference tool for you for look at Home Possible and Home One. Again, one item that really stands out. Again, Home Possible allows for up to 4 units, and Home One, like HFA Advantage, is just for a 1-unit property. And there's other type of guidelines here that are different also. But again, I just thought this would be a nice tool for you to have and something tangible to take away. So with that being said, Freddie Mac's been around for 52 years now. We were created and chartered by Congress as a GSE, government-sponsored enterprise, and we're mission-based, and our mission is to promote liquidity, stability, and affordability in the marketplace. And that's what we do. We're a secondary marketing company. We're not a direct lender, so we're not in competition with companies like Embrace. We're not selling homes like our realtors in the audience here. We're here to help, and we're here to stabilize communities, prevent foreclosures, expand credit responsibly, and educate and raise awareness. And that's a huge part of our job. And it really is enlightening, and I get a lot of job satisfaction out of being able to help people. And our foundational pillars, we have 4 of them: insights, education, mortgage products, and business solutions. So if you take a look at everything that I talked about today, you can see the thread of the items that I stressed. What were insights? What was the education element? What were the mortgage products? What were the business solutions? And really, that's what we're about. And we're here to help. That's why they have people like Jen and I out here partnering with our friends at Embrace Home Loans, and partnering with realtors and realtor associations and housing counselors to really help the home buyers and the first-time home buyers and this wave of millennials out there in the marketplace. Because like I said much earlier in my discussion, we can't do it together. It takes all of us. And this is one of my favorite slides that we have. This is the affordable ecosystem. And as you can see, it can be quite daunting for that home buyer or potential mortgager to get into this marketplace. And this kind of illustrates how many hands are in the transaction. Now, we put loan officers and real estate professionals at the top because really you're at the genesis of the transaction. If the people don't get off on the right foot, then it can be a really rough road for them. So the more tools you have, the more information you have, the better it's going to be, for that consumer. Like I said, you're fiduciaries for them. We see housing counselors on there. We see housing finance agencies, local and state governments. It takes all of us to, collaborate and make this work. And again, we have a duty to serve. I'm going to say it again. Embrace has a, mission of being, the Wider Path Home Foundation. And again, it's a perfect partnership with Freddie Mac, for companies, like us to really, really, band together and make sure that, we can support this affordable ecosystem by, increasing loan purchases, being innovative, enhance our offerings, and, really, really get our educational tools out there, make it known. And that's done by just, simple outreach. And, the more we do as far as, speaking to audiences like yourselves, the better we can do. So, my friends here at Embrace, I am at your disposal. If you like what I had to say today, we can do, these type of, webinars, throughout the year and just get into, a real educational type of format and engine to just continue to educate. So, again, it's, through strong partnerships, we're going to make it work. So Sarah and Brian, I really thank you for, giving me this opportunity today, and I'll turn it back to you.
Jim, thank you so much for all of that information. That was absolutely tremendous. We have about 10 minutes left, and I would just love to open this up to questions and to make sure that people can start to share what are the challenges that you're seeing, or what questions do you have about these products, or about how to plug in with Freddie Mac, or about the work that Embrace is doing and that Wider Path is doing, and how to plug into the work that we're doing here at Embrace. Feel free to just percolate the chat. We have a couple questions that already have come in. And I just want to point your attention as well to Brian's comments in the chat that Embrace does work with HFAs, and he's listed the states where Embrace has partnered with HFAs. And you can reach out to Rita Alves as well to learn more about any of the products that Jim has mentioned, and we'll be sending out the PowerPoint as well. The first question had to do with what is the definition of household foundations?
Was that from one of the slides?
I think it was early on. It was early on in the slides around the market, the state of the market, and the millennials. What is the definition of a household foundation? Yeah.
I think on the chart that they might be referring to was the composition of the households. And each column representative is certain married couple, single female, single male, unmarried couple, and then other. So at the bottom of the legend, you'll see what the compositions of each household were and where the chart took you. So I think it was, the 31 to 40-year-olds married couple make up 69%, just to give a point of reference for it.
Okay, awesome. Thank you so much, Jen. Did that help? If we're not getting the question answered, just please let us know and we'll jump back in. And then there was a question about, is the DTI the same for Home One as it is for Home Possible?
Jim, do you know off the top of your head?
Well, I can't give you a concrete answer on that because we don't have a specific DTI. Okay.
LPA. So for that,
yeah, LPA determines each loan individually. Okay, regarding debt to income ratio. So there's a lot of factors in the algorithm that are taken into consideration, and that's why I mentioned that specifically on the HFA Advantage program, where there's no reserves required. It's important, if you do have some cash assets, to put it in there because everything is looked at. And I'm sure as loan originators, you're seeing a trend on what's getting approved and what's not as far as DTIs. But Jen and I can't say, okay, this is the specific DTI cap, whether it's 35, 40, 45, or 50, because Freddie Mac does not publish that.
Thank you so much, Jen. So there's another question. Have the LPA algorithms adjusted this past year or so to be more restrictive or lenient?
Jim, do you want me to take it or do you want to take it?
You can take it and I'll add one.
We're constantly looking at our credit box. It's not like we go through updates or things like that where we tweak it. But our credit box is something that we are always under review and just adjusting as we see fit. It's not something that we're looking at certain things or anything like that. It just kind of plays into a lot of different factors. So yes and no. I'll put it that way.
No, that's a great answer. It's continually looked at, and and we do respect feedback from our business partners. And Jen and I are open to hear what you have to say. If there's specific areas that you feel that need to be looked at, we are the front line, and then we take that to our managers and the credit people also.
And we should have more coming on this, especially as it speaks to Home Possible as well. We don't have anything as of just yet, but I anticipate some announcements in the near future for sure.
Awesome. And then we have a question about what are the acceptable seconds for Home Possible that's available through Embrace? Brian, that might be a you question, or maybe.
Well, oddly, we would take any second that is approved through Freddie for Home Possible. So whatever the guidelines would say. Obviously, if you have a affordable housing second, and that wouldn't get the LLPA, so that would be obviously the preferred piece. But we would follow Freddie's guidelines on that.
Awesome. And then this question is, can we get a specific explanation of the soon to be launched Embrace specific program and how it will match with Home Possible and Home One?
Yep. So I'll take that. So Ron's question there. So Ron, our first part is the product that we have. We've taken the Home Possible product, and we've waived our underwriting fee. And on those cases, where they would be above 80 LTV, right, you're going to have no LLPAs. And so that's the kind of the big thing we've done. For our grant program, you could go along with a, once it's live, it would be able to be attached as an affordable second. Actually, it's not even a second because it's a grant program, but it would be acceptable down payment assistance to go along with one of the products that would be out there, whether it be a conventional product or an FHA product. And so we'll have more to kind of come with that. If you want to be a part of it, this is the plug for the COP. Reach out to Sarah, and she can get you signed up for the next COP. So if you haven't been part of the COP, you're not going to be in the launch program. And so we'll have more coming as we get our 501c3.
And I can answer questions about that too, just so you know more about what's happening there. But oddly, you said conventional max DTI is 50%. Brian, do you have any comments on that?
No, I think typically it's 50. It's all in the black box. It's all in Jim's hands. So
that is like the framework, but you will see like a 46 sometimes be denied as well. So it's very hard to say a concrete max DTI.
Yeah, and I love Jim's comment. As a capital markets side of things, more assets, the better the loan. Covers a multitude of sins, whether it's a first-time home buyer or a jumbo borrower. So get your assets, document them, get them on your application, and get them into underwriters. I know the underwriters don't necessarily like to validate them all, but the more the merrier, particularly for the underwriting engines as well.
Mm-hmm.
And Dan has a question: would multi-units, would they take up 75% for rental incomes?
I don't know the answer. James, I don't know how you all calculate that. So outside of my wheelhouse.
Mine
as well.
Yeah, I'm sorry.
But we do have our 1-800 Freddie number, which we encourage, lenders and loan originators to use, and you will be able to get a live Freddie Mac underwriter who can help you through scenarios and underwriting questions. So, you know, that it's a tremendous tool, and I think Jen will agree with me that you know, it's there for you to use. So with that type of question, I would say, yeah, please call 1-800-FREDDIE and get one of our underwriters, because, you know, we don't want to lead you down the wrong path.
And then a question about, will there be an option to combine our new grant as a third position loan with an HFA assistance Freddie Mac program? And I see another.
Steven, you're not my buddy today. Initially out of the gate, we won't be doing our grants with an HFA. We're trying to target some borrowers who may not know about, you know, the assistance that's out there. We may change our stance on that, but not initially as we launch the product.
And then Guy asked, can you comment on the income limits for Wider Path Home?
Yeah, I can't remember off the top of my head, but I think we will be going, and Audley may know this off the top of his head. I think we were going to go up to 110% AMI based upon number of people in the household, and we may have decided to go higher. I just can't remember off the top. So, but you know, I think it was 80% for one person, and then it went up from there. So.
That sounds about right from what I remember. What will be the lowest credit scores allowed and possibly approved under Home Possible and Mortgage One?
So similar again, there's no, you know, minimum FICO score per se, unless it was a manual underwrite, and then you would follow, and that would be outside of Home Possible and Home One. So that's where you would see the standard minimum FICO score. You won't have that. It's all within LPA.
And at Embrace, we've programmed our systems. You know, we had a floor that your minimum FICO of either borrower had to be 620. We've taken that away. So if you had a borrower that was, you know, say 600, and another one that was, you know, 740, I think I do my math here, divided by 2, you get the 620. So, you know, the system in Empower is set up correct, so you can have one borrower that could have a very low FICO and then another one with a high FICO. So you can put that through the system. It still is going to price, if it does have LLPAs, it will still price off the lower borrower's FICO score. And pricing for Freddie Mac isn't here, so we can't blame Jen or James. So
Thank you, Brian.
And Audley put in the chat, everybody can see, but 80% AMI for one person, 100% for 2, and 110 for 3. Thank you so much, Audley. So we just have 1 minute left. I just want to say thank you, Jim, so much for that presentation. It was just so natural and organic and easy flowing, and so much good information. I could follow. This is exciting for me when I can follow. And Jen, thank you so much for everything that you have brought to the design of this presentation, and to Freddie Mac, and to the leadership role that you play. And just thank you so much for being here and for getting in there with us and understanding what we're doing and learning what we're doing. And thank you for your partnership, both of you, and for walking so closely in step with us. And to everybody else, thank you for being here. Wider Path Home Foundation is ready. We're ready to rumble. We're ready to launch here. We have launched, but we're close to our 501c3 status. We are bringing together the housing sector. We are thinking strategically about how we can plug ourselves into the heart of communities through community development corporations, partnering up, learning how to partner with them, and learning how to be a part of not only the work of homebuyer education and financial literacy education that's happening on the ground, but also how to be a part of the advocacy towards affordable housing, and really learning about the coalitions and the nonprofits and the churches and the places of worship, and how the community is coming together to organize to ensure that there is affordable housing for all communities in all of the regions that we live in and work in. So please feel free to come join us. The work that we're doing is super exciting. It places you right at the center of being the community resource that you already are, but gives you even more tools, more resources, more access to first-time home buyers and to all buyers in your community. So thanks so much for being here. Thank you, everybody, for attending. And thank you, Embrace and Wider Path and Brian, for what you're doing. And thank you, Jen and Jim, for being a part of our team. We couldn't be more grateful.
It's our pleasure. Thank you for the partnership. Couldn't do it
You're
without
very
you.
welcome. Thank you.
Thank you all.
Thanks.
Bye-bye.
Have such a wonderful day. This is just wonderful.